The nearly 41 trillion rupees Indian mutual fund industry received a nasty surprise from the government last week when it passed a bill to bring tax parity between debt mutual funds and bank fixed deposits. With this, debt funds with less than or equal to 35% invested in equity shares will be taxed at the investor's income tax slab and treated as short-term capital gains. At present, all gains from the debt fund investments of over 3 years are taxed as long-term capital gains at the rate of 20% with indexation benefits or 10% without indexation. Return on investments of less than 3 years, on the other hand, qualify for short-term gains tax, where the investor has to pay tax at his slab rate. The debt mutual fund investments, however, will not be given indexation benefits from 1st April. Analysts said the move is a big blow to debt mutual fund industry, which commands total assets under management worth 14.62 trillion rupees as of February 2023. According to VK Vijay Kumar of Geojit Financial Services, the changes in debt fund taxation, also applicable to gold and international funds, will have far-reaching consequences. However, since investment up to March 31, 2023 will be grandfathered, investors can invest in debt funds and international funds till the start of the next financial year. Once enforced, the move may have a negative impact in the retail category, as ultra-high net worth and high net worth individuals may choose to invest in safe havens like bank FDs. The overall impact of the move will be twofold, analysts said. For one, it may trigger a flight of funds from debt funds to equities or bank fixed deposits in the short term.
Very soon, the rate cycle would peak out, even whether you take a Fed, a lot of expectation that the yesterday hike would be the last one, or there could be another maximum 25 basis hike. Same thing would happen to India also. So with another 25 basis hike, if monsoon is good, then you will see the reversal of rate cycle. So the point I am saying is that at the peak of the rate cycle, thanks to the structural change in downward trend in the overall interest rate, neither bank deposits nor mutual fund debt would be attractive for people from the return perspective. Only those who have a major weightage for safety perspective would opt for the bank deposits. But if somebody is looking at a return perspective, it is better to take a little risk and go for the large cap stocks or large cap mutual funds in the equity asset class.
Sandeep Yadav of DSP Investment Managers also shares a similar view. For any industry, removal of tax benefits is not desirable. In the short term, there can be a flight of capital to alternate investments such as bank FDs and equities. Secondly, there could be structural implications for corporate bond markets.
Mutual funds were one of the most active players in corporate bond market and used to aid liquidity. And if at all, this regulation impacts the future flows into debt mutual funds, specifically long-term debt mutual funds, this will also have some structural impact to some extent on the bond markets liquidity specifically in the coming years, and we need to wait and watch.
That said, the industry is considering engaging with the government and arrive at a mutual agreement. Analysts say debt mutual funds still offer a credible way to investors towards long-term corpus building and may not completely go out of fashion. Today, the markets will react to global and domestic developments in a holiday truncated week.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.